and welcome. You're watching Business Today Television. I'm Sakshi Batra, and this is Market Today. Everything that you need to know about the trade today, the strategies, is what we will discuss on this show. Remember, as of yesterday, we've actually witnessed a steep amount of volatility in yesterday's trade. The markets did manage to end on a positive zone, but that was not after having tested yet again the 23,000 mark for the Nifty on the downside for the second day. In fact, we've also seen sharp declines across the board, broader markets, the Nifty Bank, and all the sectors also during the course of the day. But towards the end of the session in the second half, we did see some recovery coming to shape because HDFC Bank pulled up. That led the recovery. Also, Infosys joined hands in getting that recovery to shape as well. Again, when we move into today, there'll be a whole host of cues from the global markets. Wall Street has managed to end on a positive zone. Asian markets opened mixed. GIFT Nifty also indicated a positive start to the Indian markets, and yet again there'll be many important earnings that the markets will be reacting to. Stocks like HUL, HDFC Bank, Pidilite, Gravita, they will be reacting to their earnings today in the trading session. Remember, we'll start to get some positive cues. Like I said, Wall Street ended higher. In fact, the S&P 500 on an intraday basis again hit record high levels. It was on the back of Netflix quarterly report, and also, of course, President Donald Trump's private sector artificial intelligence infra investment plan that pulled up some of the indices in the US to record high levels right there. How are the flows coming through? Well, the foreign portfolio investors have again stayed net sellers of the Indian equity markets for the 14th straight session. As of Wednesday, again, they sold off stocks worth about 4,026 odd crores. As opposed to that, the domestic institutional investors, they were buyers for the 25th consecutive session. 3,640 odd crore rupees was seen being poured in from the domestic institutional investors right there. Let's look at the few stocks that you should be looking at today. Some of them I just mentioned briefly. HDFC Bank, of course, 8% year-on-year growth in the net income, net interest income. Profit rose by 2% compared to year-ago period. Gross NPA stood at 1.42%, slightly higher than the previous quarter. Net profit also increased slightly a bit. Slippages for the quarter also rose to 8,800 odd crore rupees right there. We'll see how the markets really look at HDFC Bank. Of course, HUL is the other big number. Profitability here jumped by 19% to 3,001 crores. Revenue just about tad bit higher, 1.5% uptick. EBITDA increased marginally 2.8% higher to 3,570 crores. Margins, however, did slip just 10 basis points, and there was also an exceptional gain as well. And the board has approved the demerger of the ice cream business right there. So those are some of the details that you could be seeing from the oil and gas names. Of course, BPCL will be important to look at. Profit here has zoomed 94% odd at 4,649 odd crores. Revenue up by about 10 odd percent. EBITDA has jumped 68%. So operationally, there's been a sharp improvement. Even on the margin basis, 6.7% of margins have come in versus 4.4% as well. And the company has approved formation of a JV with Praj Industries for setting up compressed biogas plants across India. Persistent systems go forward from the IT pack will also be important to look at. So those are some of the earnings that, of course, we'll look at. But first up, let's welcome our guest on board. We have Mr. Devin Choksi joining in ECMT at DR Choksi Finserv Private Limited. Warm welcome to you, Devin sir. Good to have you with us. Past few days we've been analyzing how the big event that we were anticipating is now at least has taken shape. Dr. Donald Trump has assumed office. In just the first 24 hours, a lot of executive orders have been signed. In India, we're just trying to understand whether the orders that he's signing, whether the statements he's making will have any kind of an impact on India or not, as was being feared early. What is your own analysis of how things are shaping up thus far? Not too much of a trouble for India thus far?
I think you have got multiple questions in your question. So we'll try to address some part of it. I believe that I think India has taken a proactive position with the Trump government, and they on their own approach the subject by way of asking in which all the areas they would like India to basically, I think, bring down the duty structure. I believe that I think this is going to be one of kind of an arrangement wherein you are dealing specifically with one country and see how exactly I think you are going to bring down the duty structure for them. we'll all be interestingly watching on this particular event. But as it looks like, and as we read from the press and the statements coming out from various authorities, we believe that damage is not going to be very significant for any of our industries, even if we have to bring down the rate of duty, custom duty, import duty, as we want to call it as, for US specific consignments. In my viewpoint, I think we have done some homework on this particular subject, and we find that save except I think some items, we are not likely to get impacted on major industries as we see it. But it is little early, it is on our calculation. I think we need to see how the country takes a position on this particular aspect. And budget may probably give shape to whatever we are talking just now. I don't think that across the board duty reduction, etc., is happening. On the contrary, I believe that free trade agreement with America is going to become strengthened going forward. So let's wait and see. But as of now, I think the industry should not be having undue fear as we see it at this point of time.
Fair point, Devin sir. Just briefly mentioning for all our viewers, 23,136 flattish with a negative bias for the Nifty in the implied open or the pre-open rates. Just keep that in mind while we come back to all the other stocks too. Devin sir, IT sector is something that I want to start off with because we are talking about the US. Because this is one sector which has the highest exposure in terms of outsourcing in the US. Now, any changes in the policy right there will first get reflected on this sector particularly. We've so far not heard anything on visas or anything negative that could come in for the sector to immediately take note of. But what is your own thinking as to how should one look at it? Of course, there is a domestic trigger of earnings that has played out, and of course, the external factors that we've discussed just now.
So it's a very important point. $500 billion worth of allocation of funds have already been done for creating the higher amount of computing, that is the data center and the cloud computing processes therein has already been assigned by Trump government for USA. What it means for India is definitely we are going to be the ally partner to this particular proposition, because merely spending on the infrastructure and not having the backbone, which is your software, I don't think that I think it is making any sense for anybody to understand this subject differently. So, in my viewpoint, I think the Indian IT companies are expected to be favorably placed, if not otherwise. Uh, Whether I think we would be inviting most of the activities onshore for USA, it's a call which US government will take, because even if it becomes onshore, most of the Indian IT companies are having position onshore as far as US is concerned. Of course, their cost factor they will know better, but the fact remains that I think we are going to be favorably placed. Other part is the AI part of computing and is importantly I think position, and we believe that I think this is also going to be favorable for Indian IT companies, in particular engineering R&D space.
Right. So that's as far as the IT pack is concerned. We'll come to some earnings, sir, to take your viewpoints there. HDFC Bank first up. What, in your assessment, stood out for you in the earnings? Do you think the recovery that we've seen just to start about a few months ago on HDFC Bank can carry on with the earnings that have been posted?
Yes, on the back of two challenging quarters in the first half of the financial year, the third quarter has actually, I think, produced relatively better performance. It has been a challenging quarter for India Inc. as a whole, where the demand slowdown took place, where the infrastructure projects, I think, have just started taking off. In that kind of a scenario, the bank has produced this number. And I'm sure, I think, the banks like HDFC or even Kotak for that matter, the numbers that they have demonstrated in this third quarter is becoming a base effect now. Going forward, when we see the higher amount of credit uptake in the country because of the higher spending happening due to the infrastructure, etc., it's all going to probably work always in favor for these companies. So we remain cautiously optimistic about the prospects going forward and would think that the worst is definitely behind them. Things are looking up far better than what they were up till now. Of course, I think the situation of private credit and how they beat the cost on that front is something which we'll have to all feel as to how banks get innovated on these particular aspects. But overall, we believe that I think some of the stronger banks like DFC or Kotak for that matter and ICICI, I believe that I think they are relatively better positions at the current level.
Fair point right there, sir. Another important turning is from the FMCG pack, sir, HUL right there. Now, I want a little deeper understanding on HUL from you for our wider audiences. We rarely feel that there is any kind of a stock reaction, sharp or upward or downward basis, any one quarter earnings. HUL being such a large conglomerate that also sometimes works against it, because people usually think such large conglomerates, it's very hard to make money. They rarely make substantial moves as opposed to some of the other packs. Of course, last 3-4 years there was again nothing, just as HDFC Bank's case was for HUL too. Slowly and gradually this stock also moved up a bit. What has been the commentary, suggestion and indication as to the input prices, the volume demand right now, especially rural recovery is something that we were all looking at for such places. And now there is this ice cream demerger that's happening. Post all these changes, how are you going to be looking at this massive FMCG giant?
Again, I think it will be interesting to watch out for how they execute each of their strategies. On one side, I think they are knocking out those portfolios which are not up to the growth level which the FMCG company, which you kind of actually is expecting. On the other side, they keep adapting to the newer generation of businesses, and that's where probably I think more interesting era is emerging. That's a special trait that one would find in some of the quality companies. When the situation changes, if demands changes, I think these companies adapt to those changes very, very quickly. For example, I think they have adapted the entire supply chain logistics, I think, with the AI, and they are in a much better position to manage their entire inventory management activity along with the production through the use of AI. So, in my viewpoint, I think this company, though it may have a couple of challenging quarters, but one can't probably write off any of their propositions because I think the growth remains absolutely formidable here. But important point is that Indian consumer, whether it is urban or rural consumer, is having increasingly high amount of per capita income, and that money is going to be spent in the economy.
Yeah.
And FMCG companies like HUL, who is well positioned for various products in respective category of products, be it food care, home care, personal care, I believe that I think they are right in position for taking the advantage out of it.
Right. How would you look at ITC also? I wanted to ask you that also in the same breath. Why? Because of course, because it's from the FMCG pack, but also there is this upcoming trigger. Next week is probably when buzz is that ITC hotels could get listed as well. Once that happens, how do you see investors' approach to this demerged entity as well as on the parent ITC right now, sir?
In fact, I think the next on card thereafter the demerger of hotel business should be the agri-business or FMCG business. It could be paper and paperboard business as well. So definitely, I think one thing goes without saying that ITC as a company has started chalking out the path for monetizing the respective verticals and give them shape for higher growth. Hotel being a capital intensive business, obviously they have chosen that business first to demerge it. And subsequently, I think the larger part of the demand is going to generate from the agri and FMCG part of the business. So I would be very surprised if they probably move out and venture out separately into those verticals because in FMCG vertical the scope is huge. On the other side, I think you have the entire IT platform waiting for you to adapt. And that's where probably I think integrating some of these businesses with ONDC kind of a framework could also be a very interesting position in FMCG space, including for ITC, FMCG as well as likes of HUL as an FMCG business. So we remain distinctly positive on these possibilities. Maybe the market is discovering as to how they would position themselves, and that's where the stocks are languishing at this point of time. In my viewpoint, I think this could be a buy opportunity if the market gives one at a lower levels.
All right, understood that. Now, Devinsa, I also wanted to understand, recently we've seen how Zomato's earnings came in, cautious approach as far as competition is concerned. Now, this is when the management is making a commentary, when competition is yet to come in. I mean, like they were already aware of how Swiggy and Zomato, Zepto are in place. But even before giants like Amazon, Flipkart start to come in, the management is already front loading a lot of their expenses. How are you assessing Zomato now at around 215 to 20 odd levels? It's considerably from its record high levels as well. For those who have a long-term approach on food delivery, on quick commerce play, does Zomato still have that upper edge, versus the others, or do you think this competition is something that could trouble the valuations now again?
In quick commerce business in particular, I would think that I think balance sheet size will matter because consumer would have a limited ability to pay the platform processing fees which they charge for I think quick commerce deliveries. So in my viewpoint, I think the balance sheet size of Amazon, Flipkart remains far more stronger, and even for that matter, GeoMart, which has got a unique proposition by way of tie-up with the Kirana stores. So if this particular proposition continues to affect, I think some of the smaller players, including Zomato, Swiggy, I think they will have a challenging time. Undoubtedly, Zomato and Swiggy has created the consumer tech, which is far more superior compared to anybody else. Let us admit that part of it. But when it comes to size of balance sheet to deal with this particular pressure, I guess I think the peers, the stronger peers, are having much better advantage. So I would remain a little bit more watchful. To me, I think the Zomato and Swiggy at this point of time have a fantastic experience as a consumer. But as a shareholder or as an investor, I think I would wait because I think the valuations are far too expensive even if you take the corrected levels.
Okay, understood. Now, Devin sir, you did point out briefly that the budget is something that we will now look at as the next big trigger, and probably that will shape the direction in which the markets will really go forward from here. Post the interim budget that we saw just about 6 months ago, um, we have seen the market momentum lose a lot of ground because of the absence of any big bank announcements, probably not coming in as estimates right there. Again, the expectations, as they always, are riding high on the budget as to whether the allocation will rise on certain sectors, whether again the government will continue to push the pedal on some others. What exactly is, in your thinking, something that could the market hinge on, or bet big on? Will it be a make or break budget for the markets to continue their steam, sir?
Let's examine from A and B part, the
Yeah.
taxation part and the allocation part. The allocation part, I think, remains absolutely clear. The government's priority towards allocating to the infrastructure, government's priority to allocating towards PLI schemes of the industry, priority towards creating a social infrastructure, they remain absolutely clear. No doubt about that part of it. And on the top of it, I think they are very comfortable distributing freebies. So I think that has become part of normal budget nowadays. So we are not even bothered about that part of the allocation as far as I think the budget is concerned. This year budget is all going to be about the direct and indirect taxes. In my understanding, I think as far as the direct taxes are concerned, I think we are talking about a new tax code which has been in office. In my viewpoint, I think the government's urgent priority would be to spur the consumption that is expected to basically, I think, result in the reducing the rate of tax in this particular budget. That is exemption limits, I think, to increase. So in that kind of a scenario, if your exemption limits are increasing, I would rather like to think that market will take it very, very positively because that amount of money will be left in the hands of the consumer. Coming to the indirect taxes, I think it's all going to be about how they treat the pressure on the custom duty because of the US's requirement about the tariff management mechanism. So that would be a little bit more interesting thing to watch out for. As far as I think the market is concerned, I think we'll be very interestingly watching as to how they leave money in the hands of consumer for spending.
Okay, well, fair point right there, Devin sir. It's an always such a pleasure to listen to your clear thoughts and the wisdom that you share with all our viewers. We promise that we'll cut this out as a chunk because a lot of our viewers are wondering what do the markets have in store when it comes to the budget. So we are going to be playing this up through the day as well for our viewers to catch up onto this. Thank you so much. It's always a pleasure, sir.
Thank you so much.
All right. Viewers, markets have opened and there's a red opening as far as the benchmarks are concerned. 23,100 on the Nifty, a 50 point of a downtick, 0.2% lower. The Nifty Bank also 48,622, 112 points lower right there. Reliance Industries is opening about 0.5% lower, so you have the heavyweights right there. But HDFC Bank is probably reacting positively to the earnings. You have a 0.5% uptick right there. There's a mixed opening as far as even the broader markets are concerned, with the mid caps just absolutely flat with a positive bias right there. But let's look at some of the other sectors. Advances are 647 to 859 declines, so it's skewed towards the negative side. PSU banks are 0.5% lower. Autos, pharma is absolutely flat with a negative bias. IT is actually doing well, 1.1% higher. That is one index that's probably holding up. Let's look at some of the earnings that came in. Persistent, Coforge, these were the numbers that came in from the IT pack. So that is something that we should definitely look at as to how the earnings are playing up right there. Pre-open trades were already indicating a positive one. Yes, so Persistent is opening 4.2% higher. Let's also look at Coforge, for instance. These have been the erstwhile favorite of the mid-cap IT name, 6.8% higher for this one as well post earnings. But let's look at the big numbers. HUL, 3% down for HUL right now, 2266 after those earnings have come in. Moderation in the consumption sentiment is definitely getting reacted, even though they were largely in line with estimate earnings, but they were muted estimates as well for HUL. 3% lower for this one right there. Pidilite is, however, opening about 3.8% higher up, from the earnings. Let's look at HDFC Bank, because the Nifty Bank is lower by about 0.2%. Let's look at how the banking major is also opening at this point in time. 0.5% higher again, 1673 for this one right there. Small caps have slipped now, 0.2% lower. That's why I'm saying it's a mixed opening as far as the broader markets are concerned. Coforge is further climbing higher, 8% now up in trade. This is definitely ahead of estimates. Ultratech Cement, Wipro, HDFC Bank, Dr. Reddy's, Infosys, TCS, Grasim are some of the stocks that are holding up, but large part of the Nifty stocks are lower. HUL dragging the most, L&T, Nestle, SBI, Bajaj Finance, IndusInd Bank. These are the top 5 losers at this point in time. But the IT pack names, Infi, TCS, Wipro is holding up. That's pulling up the markets higher. Ultratech Cement, Dr. Reddy's, see ahead of earnings, some of these numbers are actually also climbing up in trade as well. So that's as far as the major index is concerned, and some of the stocks that are already getting a reaction as far as their earnings are concerned. Okay, we have Mr. Neeraj Gora now joining in. He's the fund manager at Axis Securities PMS. Warm welcome to you, Neeraj, and thank you so much for taking the time out for this discussion. We've had again a softish opening. Of course, the weekly expiry options will play out, but I just wanted to get a sense of the last fortnight odd and how things have shaped up. Of course, this is in continuation with the last 3.5 months, 4 months of consolidation in the markets. But the kind of volatility that has spiked over the last few days is something that is not going unnoticed. What would you attribute that to? What is the sense that you're getting of the current setup in the markets? Are we going to be staring at a sharper downside from here? Do you think the markets are just waiting for the budget announcements to come in? If it is in the positive zone, some recovery, but if it is fingers crossed, something on the negative side, you will see sharper corrections coming into the markets now.
Yeah, hi Sakshi. Good morning, and thanks for having me in your show. You look at the economy, like economy has not been in the best of shape for about now 8 to 9 months, right? At least like I go back to April and May when the central government was in the mode of elections, right? Things had been moderating from their point itself, right? For first 8 months, if you look at the government capex spending, because that had been one of the biggest drivers of the economy. For first 8 months, that number is down 12% versus the last year, right? So they have been slow to start the capex again. We have seen some revival in the capex, which has come in November, right? Which will continue to revive. Then second point, like what we have been seeing since at least October, etc., right? That the bond yields in US have been increasing. Also that US has been appreciating, and all emerging market currencies, including India, have been on a depreciation, right? So that's the macro that basically means that we are in a tough macro spot environment. So what is happening, Sakshi, in this environment, that froth is getting clean, right? So in all the pockets where valuations were pretty high, and if those companies are not able to meet their numbers, then the stocks are getting punished, right? Earlier, the environment was as such that if, I mean, there was a narrative around few stocks, even if the earnings were okay, the stocks were doing pretty much fine, right? So it was like a very kind of a bullish environment. I mean, I personally don't think that bullish environment is there. We are in a phase of consolidation. And what our sense is, at least for this first half, what we should look at more is look more on the large cap side, look more into the defensive sectors, like including IT, pharma, telecom, cement is close to bottoming out. So people can have exposure to that because our fiscal situation is a little bit difficult. We have been consolidating our fiscal deficit, which is further constraining our revenue expenditure and capital expenditure both, right? So I think this year will be ending at about 4.7 to 4.8 on fiscal deficit. I mean, we had budgeted about, 4.9, etc. Next year, I think the finance minister would target about, 4.5, 4.6, etc., right? So beyond that, I think we'll need to open up the fiscal space itself, because if we continue to, be very prudent and consolidate the fiscal space, the room for expenditure for the government will get constrained. So our first of all expectations for the government is to, put the, acceleration back on the capex, look at a growth oriented budget, right? So that we continue to move ahead. We need to create more jobs and we need to consume as well, but also give some stimulus on the consumption, right? Because if the consumption, as you had been talking about results from Hindustan Unilever and all that, the largest FMCGs, like they are reporting very flattish volume growth or
Hmm.
at best in a low single digit, etc. So we need to stimulate both consumption and investment and keep a little bit of equilibrium on the taxes part, right? We don't need a lot of tweaking in taxes, etc. Right? So a lot of equilibrium on that side, but still generate enough resources to continue to spend on capital expenditure as well as stimulate consumption, Sakshi.
Okay, Neeraj, also wanted to get a sense. So that's as far as how the macro picture and what are the key expectations right there from the budget, which can continue to, provide some triggers for the markets as well. I wanted to come to specifics. You did talk about FMCG. What is your own approach on this one? This has been an underperforming sector for many years now. Of course, massive changes are taking place after a long haul. HUL is demerging its ice cream business. ITC has demerged its hotels business right there. Do you think these kind of diversification and spreading out their wings will continue to help or support the prices which have so far been, in the underperformance zone? What should investors' approach be now to such FMCG giants?
Yeah, I think on a company specific basis, whether levers or ITC, I think these management are doing a pretty good job. So there is no company specific issue as such between levers or an ITC, etc. As we were talking, it's more like a macro issue where there is a softness across the board. And Sakshi, this is not just a ruler slowdown. In fact, there is a recovery in the ruler demand. There is actually even a moderation, and Hindustan Unilever talked about in this call and even a call prior to this, right? That the urban consumer demand has been moderating while they are seeing some recovery, which is happening on the rural, etc. as well, right? So overall, if you look at the consumption basket, right, that is growing in mid-single digits. And then new, categories which have come up for consumption where people are spending more. Let's say for a mobile, right? Because we spend so much time on these mobile phones, their replacement cycle has got shortened, right? Every couple of years, people are looking to buy a new phone, right? And that's become a huge category, to the extent, right? It could be taking some demand away from other consumer discretionary and staples, right? Because you think you're okay to live with other things, right? You need to spend a little bit more on the stuff, which is you're pretty much spending most of your time, off the day other than your work and other stuff, right? So I think we need to stimulate demand as we have been talking. There's no company specific issue. Hindustan Unilever is doing a pretty good job, or whether ITC or Nestle as such. Is basically you need to revive the demand that we move back, because see, generally we talk of India as still as a growing economy, right? And our per capita consumption, when we look at in different FMCG category, is still low compared to the developed countries. So there's a lot of potential, but we are not realizing that potential, right? So on one side we say that India has such a low per capita, consumption in so many categories, and at the same time, right, we are looking at the numbers which suggest there is only a low single digit or a flattish growth, right? So
Hmm.
basically, what we have seen over last few years, the kind of the inflation people had seen cumulative since COVID, right? That is higher than the cumulative wage hikes which people have received, which impacts your real spending power, right? So that has to come down. Inflation path, I mean, RBI is doing a good job of it. That continues to moderate further. And then the economy and wage growth and, more hiring happens. Then when your real income grows higher, right, it turns into a positive territory. That's where the consumption demand will come back. Or maybe the expectation could be that, we have been, looking at some of the media reports that if government can give some stimulation in form of, let's say, increasing the slabs for tax slabs,
Yeah.
right?
Yeah.
That could stimulate demand because that's needed. And I'll give you an interesting data point that 90% of the income which is being taxed is on a higher slab more than 10 lakhs. So at least they can give some kind of relief for people who are earning less than 10 lakhs, and still will not impact tax too much, right? Because 90% of the taxable income is more than 10 lakhs, right? So you will not have a significant impact, but still, stimulate demand at the lower and the mid end, right? So that will help the FMCG sector deliver far more numbers. Though they're already very efficient companies running at optimal margin structures, they just need a little bit of more, demand to happen. Sakshi.
Sure, fair point right there. Now, Neeraj, another thing that I wanted to ask you is on the IT space. Why? Because earnings are coming in. Again, this time around, we have seen better earnings come through from the mid-cap IT names vis-a-vis the large caps. Again, Persistent, Coforge. We see the reaction right there that's coming in. 8% higher for Coforge post the earnings. 7% uptick for Persistent right there. Wipro is also buzzing in trade. But and all across the board, we've seen Infosys ride the recovery yesterday. So the IT pack is definitely, being seen as a safer or a defensive pack right now in the markets. How are you really looking at the entire IT space post the earnings? What, according to you, stood out in the earnings within the IT pack for you?
Yeah, so first of all, in IT, we are seeing that the numbers are in line, or in some of the mid cap names are they better. Like Persistence have been delivering pretty consistent number. Coforge organic growth was also pretty on the higher side, right? So there are no longer any downgrades which are happening. And if the US continues to do well, right, that creates a positive impact for our Indian IT companies, right? There could be certain disruption coming in from AI a couple of years down the line, because AI has moved, from just sort of a tool which summarizing a lot of stuff to be an agentic kind of a tool which does a lot of end to end. But I think still people are very skeptical of AI and the guardrails around AI. So any sort of the disruption the sector which will face from, or any cannibalization from AI, is still like a couple of years away. So until that point of time, we see that IT sector is more a defensive bet, and that will continue to do well. But we haven't seen on an aggregate level on the top IT companies, Sakshi, the growth guidance remain a little bit in line with what people have been expecting of about 5 to 7% kind of a growth, for the next financial or calendar year, right? And if I look at the valuations, right, 4 years back, right, when the valuations were high, and they have again moved back to those kind of a high valuations. At that point of time, every quarter, not just for the mid and small cap IT, the CQGR, right, quarterly growth rate, right, compounded was 4%. Now it's like about 0.8%, Sakshi, but valuations are still high. So IT sector is definitely a defensive bet, and a lot of the institutions are looking to, have more exposure to IT and pharma. But if I look at an absolute upside, there's not a very significant upside which is available, because what I'm saying is valuations is on the higher side. But if I look at the whole basket, not on individual names, right? Earlier we were expecting, 2 years back they were doing a CQGR of 4%. Now they're doing a CQGR of 0.8% for top IT companies, right? But valuations already factor in that. So we don't see a huge significant upside. But if you want to play defensive for 6 months, right, that's a place to be there, right? But if you want to look in for an higher returns, right, you will have to either look at other spaces or, look at some niche IT companies which can continue to do well.
Okay. Along with this, Signity Tech is something that investors and viewers should keep an eye out on. 9.5% of a move on Signity as well is what you can point out in today's trade. So a sharp move coming in as, the buzz in post earnings. We are seeing the reactions right there of the partners too. Let's also look at some of the other pockets then, Neeraj. First up, I wanted to understand from you itself, which are your current, where are you currently overweight on and where are you currently underweight on in the markets right now? And how are you really deploying the fresh funds that are coming to you despite such volatility? Are you holding on to the cash? Are you deploying it, finding opportunities in these dips? Could you just give us a strategy that you're adopting in the markets right now?
Yeah, so a couple of spaces where we are overweight are like pharma, telecom, cement, etc. Right? We have a pretty significant weight on pharmaceutical, right? Because all the pharmaceutical companies, basically, even on their India business as well as US facing business, so both the engines are firing. India business is very stable, has been growing, right? And the US business, they've got special opportunities or specialty products, or they are doing a lot more CDMO, etc. Right? So there are a lot of opportunities in this particular sector, right? So we are significantly overweight on pharma space across the schemes which we manage. We also like telecom, right? So telecom we have seen has got consolidated, right? And we are playing it through both the telecom telecom guys versus also the telecom tower companies. So we own Bharti Airtel, we also own Indus Towers, right? That is the space we are overweight. We also think that cement has sort of a bottomed out, right? Because the demand has been pretty muted in the cement space. They'll make a comeback, right? Also, I mean, in terms of valuations, mostly most of the cement companies are trading at a fair valuation, right? And we would like to, look at cement companies which are consolidating rather than looking at smaller cap cement name. We'll look at top two, three companies which are consolidating and acquiring these companies and growing best in the class, right? So that is one space. We are a little bit neutral on the banks because as we have been discussing that both the monetary conditions are pretty tight, right? So it's not just about a rate cut, but because we have been running, a liquidity deficit for several months now, and even the last month we have got about a 2 lakh crore kind of a liquidity deficit, right? So our sense is just a rate cut alone won't happen when you have such a liquidity deficit. Your call money rates are much higher than the repo rates, etc.
Yes.
And we saw that from RBI that RBI had done a 50 basis point kind of a CRR cut. I think they'll need to do a lot more tools, to take this liquidity to a balanced situation before a rate cut happens or, a rate cut actually helps and gets transmitted, right? Also, what we have been seeing on the, the financial space, that the credit growth now is like the system credit growth is more like, and even the deposit growth, is more between 11 to 12% kind of a range, right? And our view is that is continuing for a couple of factors, right? Earlier, it was the deposit, which was the constraining the growth in credit. Now, more or less, most of the banks are falling in place with the whatever the RBI has communicated to the banks that they need to have this loan to deposit ratio in certain range. But there are other factors, right? A lot of unsecured lending. We have been seeing some delinquencies in those space, and RBI has also asked banks to go a little bit slow on that particular space. They have increased risk weights and put in more constraints. So we would also need to see some sort of an easing from the regulator side and for banks to accelerate the credit growth as well, right? So until unless you see that 11-12% growth goes faster to 13 to 15-8%, right? Because bank is a space which is adequately owned by institutional and retail investors, right? You would have heard from a lot of my peers that bank is a space which is not expensive, it's fairly valued, it's attractive, right? But despite being attractively valued or fairly valued, it has not been performing because one, it's widely owned, and secondly, you are seeing that there is a credit growth which is muted, and you are seeing in certain pockets, right? Because household is leveraged 4 5 year back, right, the household leverage was like 20 lakh crore, Sakshi. Today, like they have an EMI cumulative, right, which they have to pay. It's like 40
Yes.
lakh crore of payment is sitting on their balance sheet to pay, right? So with that kind of leverage, right, it's pretty significant. As we were talking, that income has not gone to that extent,
Hmm.
right?
Hmm.
So I
Fair
think we are a
point.
little bit more neutral on banks, but we still like top 2 3 private banks, right? We are not playing the microfinance still, right? So top 2 3 private banks which are continuing to do a good job, your
Hmm.
ICCI, SDFC. So we
Hmm.
continue to like them, right? And couple of leading public sector banks as well. We are not looking at this point of time on a very small finance banks or an MFI space, right? I mean, a lot of them
Yeah.
would have
Yeah.
significantly corrected. I think they may continue to correct for some more time before they become interesting.
Hmm. Neeraj, what's your approach in the broader markets right now, the mid and the small caps? Are you going absolutely stock specific right there? Are you staying clear of this space? Looking at that every time the markets correct, these are the spaces that actually face a deeper beating. How are you looking at them?
Absolutely right. And like Sakshi, when you notice once when we started correcting in October, right? All your
Yeah.
Nifty, Midcap and small cap, they were, falling almost in line, right? Because the selling was led by FIs, right? They had sold a big amount in October. Again, they're selling big in January. But now what we have seen in the month of January, as began with this question of the last fortnight, in last fortnight, we saw a huge pressure on the small and mid cap space, right? Which was not happening in October, right? But there's been a brutal correction in the mid cap and cap space. I think there are a couple of reasons. One is obviously the currency depreciation and also the leverage. So a lot of your hedge funds, prop desk, HNIs, they would be sitting on a leverage positions, right? So they would be reducing their leverage in these stocks because these stocks were the ones which were giving them higher return. If you look at calendar year 2024, right, your Nifty
Yeah.
would have given 8 9%, whereas mid and small cap would have given 15 16 in higher returns, right? So a lot of
Hmm.
allocation for these guys were more on mid and small cap space, right? And they had to deliver, right? So you saw some sort of a margin selling which kind of happened 10 days back in this space. And the companies which are sitting on a very high valuation, right, 90 100x plus, and when they are not meeting expectations or they are giving a muted growth number, right, they are seeing a significant correction. So our sense is, as you said, right, it's more stock specific approach. There are pockets which have become attractive, right? So companies which were trading at like 30 35 times, they've also corrected to 20 or 25 times 1 year forward, and we are finding very interesting opportunities in small and mid cap. What we have been avoiding names generally which are more like 100x kind of a multiple, even if let's say they have come to 80x, right? We still think that they could see a lot more correction, right? But on an aggregate level, which is what I'm talking of, right, there could be one stock here and there which is higher valuation because of higher growth, but largely we still want to avoid this space which are on a very high valuations, and rather than look at this bucket, stocks which are like 20 times 30-year forward, which are doing pretty well in small and mid cap, because I think this consolidation will also get over in next 6 months, right? Because we'll focus again on the capital expenditure spending, etc., and all of those things will start falling in place, and some point of time US dollar will also peak out, right? So there'll be more money which will start flowing into emerging markets, right? Because as long as US dollar is appreciating, right, the US mother market has been absorbing all the liquidity. So I think once that plateaus and there is more money which comes to emerging markets, etc., and people will start again looking at mid and small cap space, but still we have to be stock specific.
Hmm. Okay. Understood. I will just, take this point forward a little bit and I'll give you some sectors which have been erstwhile favorites. And on the point, maybe you can give a greater clarity to our viewers right
Hmm.
there to understand better.
Hmm.
PSU stocks, defense
Hmm.
stocks, railway
Hmm.
stocks. These were the stocks that were probably, highly concentrated in retail investors' portfolios ahead of the interim budget. And
Hmm.
many of them have started to bleed sharply post the interim budget over the last 4 5 months odd. Some have recovered, like you said, from their all time lows as well. But what is your approach here? Do you see this space again garnering favor, or do you think that they had absolutely run up ahead of fundamentals and there needs to be some sanity before investors again go gung ho over these two or three sectors?
Absolutely. So, and generally in the PSU space, we have seen, things move a lot between fear to greed, right? So if I go back more than a year and a half or 2 years, the PSU space was completely, unloved. People were not looking at PSU space. There were good companies available at 10, 15 P, right? Just because PSU, nobody wanted to look at them. To
Yeah,
completely move to a greed zone where you said, they're getting so much orders from the government, give them 40, 60x multiple. I mean, 2 years back, these companies, same companies were available at 15, and then suddenly
yeah,
people love them so much, and there was euphoria in retail that they are gaining orders. That on each order win, Sakshi, the stocks were getting upgraded by 5, 10%, right?
yeah,
But it's a normal course of a business to get an order, right? But on each order win, you'll hear that some company, shipbuilding and all those shipyards, they won this order and the stock gets moved further by a 10%. So that was completely irrational exuberance, right? So in one of my previous interviews, I mean, 6 to 9 months, I had noticed that, railways and shipbuilding, all these spaces, a lot of irrational exuberance. These were good companies. They will continue to deliver well, right? So what I'm saying is the revenue growth, that order book, everything is good, and that's a number you can't dispute, right? But what is
mm,
the price you pay for it, right? So in that sense, there was no headroom for those stocks to go further. There was a need for consolidation, which has happened. So you will see that all these defense stocks, railways, while the market would have corrected 15%, a lot of these stocks have corrected 30% plus, right? So that was the reason that, the physical growth story will continue. So one of the leading defense companies, we looked at them just about 10 days back. They have a strong order book, and our sense is that they'll continue to grow, let's say, around 13%. But earlier,
right.
the market was giving them like a 40 multiple. Now it's corrected to, somewhere in 30s. I think for a 13% growth and being just completely dependent on government nominating some orders to them, I think still in terms of price to grow through, it's like 3x. So we would need to look for some more consolidation. Space is good and there'll be a physical growth. But if you demarket, PSU space into two buckets, one is also your PSU banks, your utility companies, right? Where I think there are still a lot more attractive opportunities versus, let's say, just the railway stocks and all those, etc., right? We're just dependent on one segment of the government. So we still like few public sector banks and utility companies, which could be looked at, but we are not completely gung ho to buy a railway stock at a very high valuation. Sakshi. I mean,
Fair
these are
call.
good companies,
All
but
right.
not at that
Right.
price.
Yes, Neeraj, thank you so much for giving us all those insights. It was a pleasure speaking to you and get your perspective on the overall markets and various sectors that we discussed today. Hope you have a great time till the time we see you next on Business Today. Thank you so much for sparing your time
Thank
for
you,
us.
Sakshi. Thanks to your viewers. Thank you.
All right. Viewers, we'll start to wrap up the morning edition now. We have inched higher to the day's high just after half an hour of lying low. 23,185 from the day's low. There is a recovery of about 0.4 odd percent on the benchmark. The Nifty Bank, however, is still on the back foot, 0.3% lower at 48,578 right now as far as the Nifty Bank is concerned. But if you see, even the broader markets have recovered. The mid and the small caps are now trading, near the day's high point right there. Let's also look at some of the other pockets then to see how the markets are shaping up. So the mid cap 100 index is now up 1%. Small cap is up by 0.7% as well. That's the move that we are seeing. Let's look at some of the other sectors to see how things are shaping up. So the Nifty Bank is lower. Autos are half odd percent higher. IT index is soaring high, of course, led by those incredible names. Coforge is now 10% higher post those earnings. So persistence is up about 7.5%. So it's the IT pack that's garnering all the attention today. A half odd percent uptick for the pharma index, healthcare index, consumer durables are also up and about in state today. whereas the financial services are also up. But it's a mixed trade clearly as far as the markets are concerned right there. What we'll do is, viewers, we'll wrap it up at that, but do stay tuned throughout the course of the day. You know that we are going to be getting you a lot of earnings conversations from some of the top managements which have reported their numbers, so that you can get a deeper understanding of what goes next post the earnings, as well as we will get you all the action live from Davos as well. So stay tuned for that as well. Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and this is the earnings special edition where our focus will be on PNB Housing Finance and its numbers that have come in. A robust set of numbers yet again, another this quarter where the net profit has increased by over 42% on a year-on-year basis. What we've also seen is that the net interest income has also seen a growth of 17% on a YOY basis as well, to 695 odd crore rupees right there. The net interest margin now in Q3 has also stood at 3.7 odd percent right there. We've also seen a growth as far as the disbursement, the loan book is concerned. The retail loan asset that has also grown by about 17.5%, led by, of course, growth in both the affordable as well as the emerging markets as well. To discuss with us the key fine print, what has gone into the key contributing factors for this quarterly earning, as well as what is the outlook, now we are joined by the top management of the company. Mr. Girish Kauski joins in, the MD and the CEO of PNB Housing Finance. Warm welcome to you, sir. It's always a pleasure to have you with us. Congratulations on another set of strong numbers that have come in Q3 for you. Do tell us, sir, any top 2 or 3 factors that have led to this strong growth continuing for you in this quarter?
Well, good morning, Sakshi. I think you have said all the numbers, so you made my job a bit easier. So I think quarter 3 was pretty good. In fact, the first 9 months, all the 3 quarters in the year has been pretty good for us, even though no, there were certain challenges in the industry. In the first 9 months, we've done well quarter 1, quarter 2 and quarter 3. We had guided retail book growth of 17%. So as of quarter 3, we are at 17.5%. And we'll be able to surpass 17% by March. So that's the guidance and target on book growth. So our focus was very clearly a couple of years back, we wanted to grow our retail book, and we also wanted to increase the margin, and therefore we started affordable business little over 2 years back, and as of March the book was about 1790 crores. In the first 9 months of the current financial year, we have doubled the affordable book. So now the book is 3,838 crores. We started emerging verticals this year because it is a yield accretive business, and now the book is about 13,000 and odd, and we've also grown that pretty well on a YOY. So overall disbursement growth on a YOY is 31%. In fact, margin is quite stable, 3.7%. PAT growth is 43%, ROA is 2.51%. I think overall credit cost has been benign, negative 19 bips. So I think overall we are pretty much happy with the quarter 3, and we are in line to achieve our stated objectives for the current financial year.
Okay, got that. Right there, sir. Do help us now understand as far as your NII growth outlook is concerned from here on. How do you see that substantially growing to in FY25? And also, if you could give us an overview as far as how FY26 could look in terms of the NII growth, sir.
So if you look at last 2 to 3 years time, no, in the portfolio we also had a large chunk of corporate. So we had decided little over 3 years back to degrow corporate book and also work on frequencies because we had high NPAs. So as we speak, I think about 3 quarters back we made corporate NPA as 0, and we have ran down the book. Now corporate book is only about 1240 crores. So the NII pressure what we had in last couple of years, I think now it started improving because the corporate share in the overall portfolio is now minuscule. It's about 1.5% because the overall book is about 72,000 crores. Out of that, retail 70,686 crores. So I think going forward, net interest income should improve from here on, and we've seen that from last quarter itself, and this quarter it's about 17% growth. Now the dependency of corporate on the net interest income is very, very less, and when we start corporate business, let's say from this quarter, it should further add to our growth on NII.
Okay. And on the margins front, sir, how do you see NIM growing from here on? Are you comfortable with the current levels? Is there scope for further improvement here as well?
We had guided the 3.5% of NIM, but we've been able to maintain 3.6% plus.
Yeah.
And in quarter three it was 3.7. So we will be able to maintain in this band of, let's say, 3.6 to 3.65 for next few quarters. Even factoring the rate cut which might come through in next few quarters. What we have done is, as I had mentioned, we have completely exited super prime because their margin was quite low, and
Right.
we are getting our prime book at a slower pace because even there the margin is low compared to emerging and affordable. So we are growing our affordable and emerging book much faster. If you look at quarter three, 38% of disbursements came from affordable and emerging. So with this change in mix between segments, we are into three segments: prime, emerging, and Roshni. With focus on Roshni is affordable, Roshni and
Yes.
emerging, the margins will improve. So after about 3 or 4 quarters time, I think the margin should slowly inch up because we have guided the NIM of about 4.1% by FY27 with a
Correct.
retail book of about 1 lakh crore.
Right. Okay. So, you did say that, you've already managed to surpass your own guidance when it comes to the retail loan now at 17.5%. And that's, 1 quarter still remaining. Would you be comfortable to revise the guidance upward for FY25, or would you stay with this? And for FY26, then what will be the guidance on that front, sir?
See, if you look at any year, quarter four is the best quarter for any company, especially in this space. So I'm sure we'll also do well in quarter four. We are at 17.5 now. Guidance is 17, so we'll be able to surpass. I don't want to put a number now because it's only 1 quarter away. So we had guided
Yeah.
17. We are at 17 and a half. So I think I'll stay with that. But I'm sure we're going to surpass our guided target of 17%.
Okay. And, that 1 lakh crore mark, by when are you expecting that, sir?
We are expecting a retail book which is now 70,656 crores to reach 1 lakh crore by FY27, March 27, and the composition will be today the affordable book is 3,838. By this March it will be 5,000 crores. By FY27, out of 1 lakh, affordable will be 15,000 crores. Emerging book would be about 25,000 crores. So 40,000 crore book would be high yielding business, and the balance 60 crores would be in prime.
Okay, understood. So do tell us, within this October to December band, what was the impact of the festive demand? Was it as expected for you as far as the loan disbursements are also concerned? And now what is the outlook?
So if you look at the whole year till now, I think demand is pretty good. Demand is quite robust in all the segments, and this is what even all the developers are saying. Super luxury, bit size. I think across demand has been quite robust. Talking about quarter three, I think demand continued to be robust, but there were a lot of challenges in certain states. With respect to elections, with respect to a lot of festive holidays, and also a couple of states like Karnataka and MP, there was a change in registration process which actually had put a hold on disbursements. So I think because of that, I think you will see the industry disbursing quite less in quarter three. Otherwise, the demand is quite robust. We still managed to grow sequentially, book by 4%, and there's a marginal growth in disbursements.
Okay, got that. Mr. Ghoski, another space that I wanted to ask you is as far as the interest rate scenario is concerned, sir. How are you expecting that to play out? Again, there is some kind of a question as to whether the RBI will have enough levers to immediately go ahead for a rate cut right after the budget when the meeting will incur, or do you see further delay now happening in terms of the interest rate cuts happening? How is the scenario playing out there, sir? And how will it impact the loan demand and the overall housing market?
So in terms of rate cut, I think a lot of discussions have happened in last few quarters, about inflation, rate cut, liquidity crunch.
Yes.
Right, so I'm not very sure. I can't confirm what will happen in the next MPC, but we are expecting rate cut to start sooner than later. It might probably happen in February it could be maybe 25 bips. So a 25 bips rate cut would impact us on the cost of borrowing by 10 bips. So that we will pass it on. And since we are going to start corporate, it will help us on the margin. We are changing segment which will get us a higher yield. So our yields would improve. And also in all the three segments, that is prime, emerging and affordable, we are trying to up the yield. So we will be able to manage to a large extent, and we don't see any challenge, in the medium term with respect to rate cut.
Okay, got that. Sir, I did ask you last time around as well, and I still want to follow up on that question. And as far as the PMAY interest subsidy scheme is concerned, which is expected to benefit 1 crore customers over the next 4-5 years. How are you really positioned to capture this opportunity for yourself, sir?
I think it's a great opportunity for the entire housing industry, especially companies focusing on emerging and affordable, to a certain extent on prime, because PMAY inter-subsidy scheme caters largely to EWS, LIG and part of MIG. This scheme started from 1st of September of this year. We have already, done business close to 5,000 accounts, 5,000 customers. In terms of amount, it's about 675 crores. So it has taken off very well, and I'm sure this is going to really help demand to go up, and we are very positive about the scheme.
Okay. And lastly, sir, I did want to ask you, as far as the upcoming budget is concerned, what is your big expectation for the sector you are catering to right here closely? What remains to be seen as far as what the government could do to further, improve the demand here? Already, you did say that, a lot of segments have reported positive demand, but what exactly is needed at this hour, and what would be the big ask from the upcoming union budget?
I think from the industry perspective, there are three asks. One is the limit on interest and the principal that can be enhanced. That's 1 and 2. The third one is on the affordable side, the supply from the developer side is quite less because of the challenges, because these projects for developers are not viable, and therefore a lot of developers are focusing on super luxury and luxury apartments. They're not getting into affordable. So some kind of tax ops for affordable projects, that would help to further improve and increase demand on the affordable. So these three are the expectations from budget.
Okay, wonderful speaking to you, Mr. Kawski. Thank you so much for sparing the time for us, helping us detail the insights from your quarterly earnings. I wish you all the very best for the upcoming quarter as well. And we'll hope to catch you very soon post the budget to take your first reactions right there too. Many thanks for being with us on the show, sir. Thank you. With that, viewers, we wrap up this special conversation with PNB Housing Finance on the earnings as well as on the budget expectations right there. Do stay tuned. We will continue to get you such fascinating insights from the top voices of India Inc. right there when it comes to the earnings that are being reported and, of course, the big expectations from the budget too. Stay tuned.
Hello and welcome to Business Today. I'm Siddharth Zarabi, and with me today from our Davos studios, Mr. C.S. Sethi, the chairman of the State Bank of India. Welcome to our studio. Mr. Sethi, I'm going to dive straight into the topic, the big macro backdrop and financial stability, global interest rates, what's going to happen to tariffs and economies like the United States. One of the key discussion points really here at Davos. I want to begin by hearing your insights, what you have picked up from your global counterparts about the state of the global economy and trade in some ways.
Thanks, Siddharth, for having me on your show. I think it's an honor to be here. As far as the talk in Davos is concerned, the India story still continues to be positive, despite whatever couple of quarters we have had, degrowth, or the growth not happening as much as we have anticipated. From a global economy perspective, I think there are certain challenges and there are certain uncertainties both on the geopolitical environment, particularly on the tariffs, what you mentioned. Everybody is concerned how the trade and tariffs are going to behave, how it is going to impact China, India, and obviously, rest of many countries, what they're talking about. But my assessment is that India, that way, has diversified its export, both in terms of product range as well as the markets. So even if assuming that, there's going to be some action on the tariff side, we believe that it is not going to really impact India in a big way. As far as the economy is concerned, the stability of banking system is strong. If you have seen the financial stability report, which is released by the RBI recently, the stress test indicates that the bank balance sheets, the financial system balance sheets are strong enough to, face any challenges which are going to happen.
Shock.
Yeah, right. So obviously, the capital buffers are sufficient. But the yields going up in the developed economies obviously will compel central bank to look at, some rate cut somewhere in the February itself. That is our assessment. Yeah.
Do you expect the changes that we saw in yields globally, is that phase over, or do you expect that to continue? And if so, how far?
The yield movement, of course, in the US, with the recent change in the political helm of affairs, obviously had moved up, and that volatility probably will continue for some time, both in terms of yields of the securities as well as, that yield movement will impact the capital markets across the globe, including India. So I think this uncertainty will be there for a couple of months.
Yeah. One of the things that is being picked up here is the fact that most US CEOs appear to be very confident about the prospects of the US economy.
Yeah.
And that, because of its status as the largest consumer economy in the world, will have a further second round impact. Given that you spoke about your expectation of a February rate cut in India, is that just going to be a one-off, or do you expect that to be the beginning of a rate cut easing cycle to some extent?
So the yield, as I mentioned, in the developed economies, yields going up, there will be some pressure on the central bank back home to ensure that, the expectations are met. So our house view is that the February rate cut would be smaller in size, more in terms of signaling that, the central bank is ready for this. And then the overall, in the calendar year, in 25, 50 to 75 basis point is an estimate what our house view is there, starting with 25 basis rate cut in February.
Okay. Yeah. So that's a very clear point, the house view of given by the SBI chairman. I want to turn to one sector which has also dominated the discussion back home, and which is what is happening to the currency. That obviously has a benefit when it comes to our export, but it has a negative impact when it comes to imports. I wonder if there is a house view on currency also that the State Bank has.
I don't want to take a call on which level it will be, but would like to give a couple of statistics in terms of, I think this is also we published in the public domain, our research department. If you see from April 21 onwards, the rupee movement was closely linked to the dollar index. As the dollar index strengthened, the rupee depreciated.
Absolutely.
It is almost similar level, 17% movement from April 21 onwards, purely on account of the dollar index movement, which is, a different scenario from global financial crisis, what we have witnessed. If you go back to 2008 to 2014, the dollar index had hardly moved 3 to 4%, but the rupee depreciated almost 45 to 46%. So, which means that among the emerging nations' currencies, Indian currency has done fairly well, and it is linked in more in terms of dollar strengthening than
and not a weakness of the economy per se.
Exactly.
But Mr. Sethi, I have seen one brokerage report which is very clearly saying that India is in a structural slowdown now. It goes on to call, for example, for specific consumer side, consumption oriented measures. Is that a view that you share? Because, the State Bank of India has its pulse on everything of the Indian economy. Are we in a structural slowdown?
I don't call it structural slowdown. Earlier also I had mentioned that, this is a temporary phenomenon what we are witnessing. Structurally, India is in a good position, good story to continue. But definitely there are certain challenges in terms of core sector not investing, private consumption, private investment, capital investment, particularly in the steel and cement is not happening as much as we anticipated, because these sectors have reached the capacity utilization of 75%. I think they're all looking at the external environment, how it is going to behave, particularly on the steel side. But there are investments which are happening in the renewables, roads, and we are witnessing that investment. But the core investment is critical for us. It has to come back. The private capex has to come back. It has got on the effect on the consumption also, obviously. So hopefully, the budget will give some spur in terms of the consumption.
Is there a trade policy response required to, for example, for the steel sector, which is also facing some pressures on account of imports, and we know what is happening on that front? Is there a trade policy response also required from a tariff point of view?
So I think a lot of efforts are being made in terms of assessing, what are the impacts, particularly certain categories of product in steel, for example, whether there is a potential undercutting of the import costs. And maybe, some measures in terms of anti-dumping would help the industry in a big manner.
What's your outlook on credit growth, Mr. Sethi? Because in the backdrop, I think, the juncture that our banking system and overall economy is that there are certain pressure points in terms of consumption. We saw what happened in the automotive space, for example. Real estate is also pretty delicately poised because some people are saying that prices have reached overheating territory in certain segments. So given that, what's your outlook as far as credit growth is concerned?
Obviously, I can't talk about SBI.
At an industry level.
Industry level, whatever we have seen, the results coming now from the banking system, and also the numbers what the central bank has published, there seems to be some, convergence between the deposit growth rate and advances growth rate. Obviously, about 12% is the advances growth rate and around the same level in the deposit growth rate. But mainly the credit growth is continues to be coming from the personal segment. And among the personal segment, personal loans, home loans continue to be a robust sector. So broadly, I think lower double-digit growth is what we are anticipating, the credit growth for the system. Yeah.
Do you think a period has been reached where earlier RBI concerns around unsecured loan growth and some of the measures that it seemed to respond at a systemic level, that phase is over and the regulator would be more sanguine right now?
The growth rates of unsecured personal loans obviously, slowed down with the measures what RBI took. There are some structural changes also what RBI has done in terms of ensuring that both at the individual level and the household level, the debt is not, leverage is not as much as, which needs, which develops some concern. That structural change is basically, frequent periodical updation of the credit scores and credit history, which makes the lenders to take a call what is the leverage at the individual level. Obviously, it has now, I believe, is stabilized in terms of the growth rates in unsecured personal loans.
So it's stabilized and hopefully that is going to continue to be there. I want your view on inflation, because when I spoke to you around 6 weeks ago, from that time to now, have you had occasion to look at the inflation prospects, and what's your own reading of how that will pan out? Because that obviously will have a larger bearing on overall monetary policy and liquidity management as well.
Yeah. The last time also, I did mention in terms of the concerns on the food inflation side, the crop which is arriving, we are seeing that, certain categories of food, the inflationary pressures have come down. Hopefully, the Rabi crop also would be having a good output now. It would help us, to presented good numbers in terms of food inflation point of view, which would enable the central bank to take a call on the interest rates.
Absolutely. And that will be a crucial call. As we wind down the conversation, I want to turn to the overall backdrop. 3 years ago, when I had the then SBI chairman pretty much seated right here to now, India's banking system and the kind of repair and growth we have seen over the last 10, 11, 12 years is now, how would you describe the health of the Indian banking sector as of now?
This has been a strong footing, even the financial stability report which has come, recently, places the banking system in much robust condition, particularly when you apply the stress test, the capital buffers are sufficient. There are two things. One is, of course, the banking system has strengthened the balance sheet. More importantly, I believe that we have strengthened the underwriting processes. We have adopted technology and digitalization a big way, trying to reduce the operating costs as much as possible. So I think we are much better positioned if any headwinds are going to come. Definitely, the banking system got benefited by the benevolent asset quality life cycle which is going on now. Hopefully, this will continue for some time. But with our process improvements and underwriting standards being improved, this cycle probably get delayed, in terms of how the banks are going to look at it.
One final question, because we are at Davos and the subject is the intelligent age and technology, generative AI. You yourself have an interest in this subject. Banking and technology, what have you been picking up in terms of the future frontier possibilities?
There's a humongous discussion in terms of productivity improvement AI can bring in. And my view is that while we have adopted predictive analytics in a big way, most of the banks, large banks, we still have a long way to go in terms of the AI adoption in the risk management, customer protection, and more importantly, increase the productivity of the employees. So 2-3 things which have come up. I spent considerable time talking to the technology industry experts who have come here, particularly on the AI side, because we intend to scale up our AI adoption within the bank, is that the time for AI investment is there, number one. Number two, the AI investment costs have come down, which is a good news for many of us. Number three, and most importantly, what they said, that's the AI adoption should go along with the change management, what we have to do among the people. Because ultimately, the people are the ones who are going to realize the increased productivity. And AI is obviously a set of tools, right? So the change management is something what we need to adopt internally to ensure that the AI rolling out is more meaningful and more effective.
Do your colleagues, the entire rank and file, do they fear AI, or are they openly willing to let it augment their own business processes?
Yeah, you use the right word in terms of augmentation. I think it's not in terms of replacement or substitution of the human resources. I think we are focusing more on in terms of providing the capabilities to them to perform better.
Absolutely.
Yeah.
Mr. Sethi, there's so much more to talk, but you have a pretty packed schedule here at Davos, so I'm going to let you go at this stage and wishing you all the very best. That was the chairman of India's largest bank with us here from Davos. I'll be back with more. Until then, goodbye.
At Davos, there's a huge amount of optimism amongst industrialists, particularly American corporates, when it comes to the impact that Donald Trump's presidency could have on the American economy and what they think would be the spillover effects on the rest of the world. But there are some pundits who are signaling a note of caution, and primary among them, Martin Wolf, chief economic commentator at the Financial Times, is joining us now at the India Today Business Today studios at the World Economic Forum. Thank you very much, Mr. Wolf.
It's a pleasure to be with you.
Fantastic to have you back with us. As I attend a lot of these sessions with American corporates, they're very rara, gung-ho. It looks as if their animal spirits have been unshackled and they think that America will conquer the world again. This is going to be net positive. for the US economy and for the rest of the world. Why are you so alarmed and concerned?
Well, first of all, I'm not surprised. And the one really important point is it's sort of business's job to be optimistic. That's what carries them through. Otherwise, you would never take the risk, make the investment. So the characteristic of a good business person is to be an optimist. And I like that. I'm wildly in favor. My job as an economist is to try and analyze, as far as I see, rationally, soberly, and looking at the pluses and the minuses. The second reason why they have a very understandable enthusiasm is that there will be a lot of deregulation, and that will allow them to do what they like without regulators and civil society actors who disapprove of them, all trying to stop them from doing what they want. Well, if you tell somebody of any age, just go and do whatever you like, well, they're fun, isn't it? Of course, that's much better than being told, but no, you can't do that, and you can't do that. But it doesn't always end up well. So just to go back to history, and I don't want to go a lot, but in the early 2000s, the Bush administration deregulated very significantly, and that followed on quite significant deregulation in the late Clinton era, particularly the financial sector. And in 2007-8, it blew up stupendously. And nobody said, by the way, we're going to have the biggest financial crisis since the early 1930s as a result of all this. So this enthusiasm of business, perfectly understandable, is natural, but could be very, very mistaken. And the second really important point, the US economy is already doing very, very well. It has full employment. It is the only major economy whose GDP is above its pre-crisis trend. It fully recovered, more than fully recovered, from the effects of the global financial crisis. Innovation is going gangbusters already. It is the world leader in artificial intelligence. Its tech companies are dominant. They've done spectacularly. So the idea that there will suddenly be some break in the trend, which they promised, by the way, in 2016 with the tax cuts, it didn't really happen. It seems to me very implausible. So I just think, I'm not saying there'll be a disaster. I can give you lots of scenarios in which things will go wrong. The fiscal crisis could emerge and so on, but it's
let's build on some of that. What all do you think can go wrong? Because you're listening to the positives about companies wanting to come and invest in the United States, America wanting to, push its way around and not be bullied or taken for a ride any longer. But build out some of the scenarios where you think things could go wrong and why.
Yes, I think this idea of America being bullied is a little strange for us in Europe to accept. I mean, it is the world's greatest power. It has been the world's greatest power for 100 years, and nobody's bullied it. What it wanted to do, what it did is what it wanted to do. What are the risks? Well, right now, unlike 4 years ago, the economy is pretty clearly at full employment. The Trump administration has a plan to remove a lot of workers. So it's going to have excess demand for workers. That's a natural. It's also plans to put on a lot of tariffs, which will pull activity away from workers from where they are to some other activity which is protected. They want to close the current account deficit, the trade deficit. That will increase demand even more. So there's going to be a huge boost in demand and a contraction in supply. To economists, that means inflation. It's very plausible that inflation will return, and obviously the Fed is a bit concerned about that already. That could mean higher interest rates. And then you have two risks. Higher interest rates could slow the economy rather dramatically, but that may be less likely than that you begin to get real financial tensions. There's an immense amount of debt, public and private, right now. Public sector debt is exploding. It's well above 100% of GDP and rising. There's a lot of private sector debt as well. And the stock market is hugely highly valued. There are only two previous episodes in American history for the last 150 years when the stock market overall is as highly valued as it is today. If you add those things together, it's really not very difficult to imagine that will be quite